Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. I just want to say this straight out the gate. This is not going to be like the usual, very polished video with a bunch of editing and all that type of stuff. I want this to be a little bit more conversational, and I actually need your input. Thankfully, through doing YouTube, I've collected a lot of great minds in the comment sections and Twitter and that type of stuff. So I'm actually doing this video to kind of create a conversation, kind of open myself up to your input, and try to see whether or not I'm actually going to go through with this, which you're probably guessing. What is it, Arya, that you're going through with? I'm thinking very strongly about possibly trimming a little bit of my Salesforce and allocating that to ASML. And I guess to kind of set the stage, this is a little bit dated. This is from a week ago. But currently, Salesforce makes up, it's my biggest position. It makes up about 33% of the portfolio. And I think, I'm not sure, and I'm kind of creating this video to kind of sell you on both sides of it, but I think it's a little bit overextended, at least short term. The prices ran up a lot, but I'm not sure if it's like technically overvalued based off of like the free cash flow metrics and that type of stuff. Again, we'll dive into this in my spreadsheet later on. And at the same time, ASML, I think, is extremely discounted relative to where I peg the fair value to be. And unfortunately, I'm not in a position to have ample amounts of cash to kind of dump in these opportunities as they come. And so I look across my portfolio, and like MasterCard sticks out as like an expensive business, but I'm just never touching that. I'll do a video on that later on as well, of like, that is the only buy and hold forever stock that I'm ever going to have. And then at the same time, I look at some other possible trims. I'm looking at Amazon. I really don't want to sell Amazon. I think the long runway of growth that they have ahead of them, that's just absolutely massive over there. And so we're kind of left with Salesforce. And that's what today's video is about. First and foremost, I want to run you through where I get my numbers from. Then we'll obviously go to the spreadsheet. I'll show you how they kind of stack up against one another. And I've actually built out some models over the next, call it 3 to, I think for ASML I did up to 2030. And some of my numbers are actually from finchat.io. So big thank you to them. We're going to talk more about how great that platform is and all that type of stuff later on in the video. So for starters, in terms of the ASML numbers, because I really don't trust the word of analysts at all, I only look at analyst estimates for like very high reoccurring revenue businesses. Like for example, MasterCard is very, very predictable. Basically down to like a couple decimal points, we're going to know how much revenue they're going to do in the next couple of years. MasterCard knows it. We know it. The analysts know it. So it's very safe, I guess you could say, to kind of trust the word of management and analysts when it comes to actually looking at the guidance for MasterCard's revenues. With ASML, it is a semiconductor name, which instantly screams cyclicality. Add on the complexity of like they're a hardware maker within the chip industry that just multiplies the cyclicality of that business even more. So ASML themselves, they kind of give us these guidances of like 45 to 60 billion in revenue in the year 2030. And that's what we kind of go based off of, like the extremely long term. That's what they think they'll achieve, right? And then with Morningstar, I trust them a little bit more, but kind of just to like finger in the air, like just get some numbers on the ground. I want to look at the fair value and profit drivers segment of the Morningstar report. And so for them, they model for the next decade that revenues are going to, I should maybe move this here so you guys could see better. There we go. So for Morningstar, they model that for the next decade, they expect 10% compound annual growth rate in revenue with EBIT or operating margins of 31% from, they say from 31% for that to improve to 45% in their terminal year, which just means their last year. And then they mentioned something about EUV, high NA. Okay, doesn't matter. Anyways, so the key takeaway from that is that they expect 10% sales growth until 2030, was it? Yeah, 2030. And then the steep expectation that operating margins are going to expand to 45% by the year 2030. I'm very speculative of that actually happening. Me personally, when I'm modeling it, I'm probably just going to do like 35% operating margins in that year, just to play it safe. I really don't trust, like you're coming up on MasterCard's operating margins at that point, right? Like I don't really believe in that. And then in terms of Salesforce's numbers to kind of use in my spreadsheet and that type of stuff, I am actually using the analyst estimates. And again, for very predictable businesses such as Salesforce, I think this is a very safe means of kind of getting some numbers. And so with that being said, I simply am just looking at the free cash flow number in 2027, which is $15 billion of free cash flow. I do think that they can actually probably just purely through margin expansion, I think they could achieve like 35% free cash flow margins and actually come above that. So I didn't put 15 billion, I put 15.6 billion, which again, that's assuming 34% free cash flow margins by the year 2027, right? And so this is kind of what you end up with. It looks more confusing than it actually is. This is the Salesforce scenario, and we're taking the current beginning year of free cash flows, which is 11.7 billion, and then we're taking the final year in 2027, that's going to be 15.6 billion in terms of free cash flow, and then I'm adding like a 3.5% buyback on top of that. What you end up with is roughly 10% or 14% free cash flow or free cash flow per share growth. And so all the way at the bottom here, this is probably the most important thing if you're going to take away from this spreadsheet. This is kind of like a valuation distribution. So depending on what valuation it trades at or what free cash flow yield it trades at, what would be your stock stock return in the blue at the bottom here, right? So just for example, like if it trades at a 4% free cash flow yield, that means that if you buy Salesforce today, you're going to be receiving 11% per year in terms of stock appreciation, right? And then by some miracle, if it trades at a 3% free cash flow yield, all of a sudden your stock price returns per year more than double to 22%, right? So you guys kind of see the point of like valuation is actually something to be very worried about, at least in the, call it 3 to 5 years-ish. Obviously in the very, very long term, like 20 years plus, valuation is increasingly unimportant in terms of your total stock price return. But I'm personally not investing for 20 years, at least with Salesforce. My time horizon is realistically like 3 to maybe 7, 3 to 10 years with this business, right? And so actually I think this is a very appropriate sort of, I wouldn't call this a DCF, but kind of scenario of how Salesforce's future might pan out. I think 10% free cash flow growth is not that aggressive at all. I mean, that's realistically just a little bit of margin expansion plus like a 8% revenue growth, right? Like it's really not pricing in that much growth, especially for a business of Salesforce's caliber, right? And so currently they trade at a 3.7% free cash flow yield. And if we were to literally just project the identical thing, so we'd say Salesforce would stay at the identical free cash flow yield, it wouldn't get more expensive, wouldn't get cheaper, you still end up with like a 14% return, again, on like pretty conservative numbers. If it were to go down to a 4% free cash flow yield, which is lower than the S&P 500, so it would be cheaper than the S&P, of course, like not adjusted for stock-based comp, but still, you would end up with like a double-digit return from today's price, not to mention like any upside in terms of buybacks, dividends, or anything like that, right? Like more than the 3.5%, right? And so with ASML, which is like kind of what I would be trimming into, it does look slightly better. And I did have to do a lot of back of the napkin math with ASML in particular, because these are not the actual free cash flow numbers, right? And to kind of demonstrate that to you, if we jump back over to FinChat, and then I'm in the charting tab here, so then I just simply search up ASML, so ASML pops up, and if we just simply pull up, I want to do two things: free cash flow, obviously, and also free cash flow margins. You might observe two little things about this. First and foremost, the free cash flow margin has been extremely cyclical over the past decade. We've seen lows of 6% and we've seen highs of 60%. And to kind of combat this, we could do two different things. One, we could just simply toggle on the average, but then again, that kind of gets skewed either to the bottom or to the top of the data range, just again, simply because of the massive outliers that we've had. So instead, what I'd like to do is toggle on the median line. And I think that is a more accurate representation of like the average free cash flow margin of ASML over the past, call it decade. So roughly in the 21-ish% range. I think that would be like an appropriate adjusted free cash flow margin if this business were to run like outside of the cycle, right? Or like it should average that. If you're going to have like a 10% year and a 30% year out into perpetuity, technically it's averaging like 20%, right? So I kind of adjusted for that. So when you run it with those numbers, actually ASML doesn't look appealing at all, right? It's giving me like 6% returns, 7% returns. It actually makes sense to sell ASML to buy into more Salesforce. But again, this is ASML is a very, very cyclical business, and their cash flow timing isn't a real proxy of true profitability. So instead, I'm going to do what Morningstar was doing, and I'm simply going to toggle on operating income instead. And we're just going to look at operating income and operating margins, as a matter of fact, over time as like a better proxy of actual profitability for this business, right? So with operating margins, you can see it's around 31% at the moment, peaked at 35 recently. Morningstar says this could go to 45%. I am, again, very, very doubtful of that. I'm just going to put 35% in for our actual calculator. And I think the 10% revenue growth is very appropriate. It actually falls in line with what ASML themselves have to say. So they've actually guided for, again, I think it was between 45 to 60 billion. So I'm saying 55 billion American dollars of revenue, 55 billion American dollars of revenue at a 35% operating margin. So in the year 2030, you're going to have just shy of 20 billion in terms of operating profits. And if we adjust actually we don't need to adjust because it's currently at 9 billion, right? So if you literally just take the past 4 quarters, it's at 9 billion. And then we have just shy of 20 billion in the year 2030. And so all of a sudden you end up with like 16% growth in terms of operating income. Again, if we chuck it on the kind of the free cash flow yield distribution, even if ASML were to trade to like a 4% free cash flow yield, you're still geeking out a higher return than Salesforce if the valuation were to stay roughly flat, right? So when I had this, I thought personally, just purely based off the PE, the EV to EBIT, projecting growth, that type of stuff, this whole time I was thinking like, oh, this is very heavily in favor of ASML. ASML is so cheap, the stock has fell so much. But after doing this, I realized like it is undervalued, yes, but the discrepancy of like ASML is really undervalued to Salesforce is really expensive. It's not there yet. Salesforce is maybe slightly expensive. Like you still end up with like double-digit returns for the next 3 years. And then on the other hand, with ASML, yes, it is cheap. Yes, you're getting like a mid-teens growth rate, but it's not like a pound the table, oh my God, we need to just put as much cash as we can into ASML, right? You're still going to have a wonderful return from here. And actually, I would probably project that their valuation is going to play a big role in terms of the growth rate for this business. business over the next, call it again, 5 years or so. So I think they could probably trade up to like a roughly a 3, maybe 3.25% free cash flow yield. So your actual returns will probably be like 17, 18% going forward, but we should probably be decently conservative, and like it's probably not best to be projecting multiple expansion into the future, especially if like it's a business that's going to be having slowing growth, as ASML is. They're going to experience slowing growth in this decade compared to the previous decade that just passed. So through the process of like kind of making this, I kind of realized like maybe the best route of action is just like sit tight, don't touch anything, let compounding do its thing. Again, I want to open this up to kind of have a conversation with you guys, the viewers. Many of you have reached out to me, just very incredibly smart people, all of you watching. I'm assuming if you're watching this type of content, you're sticking through 15 minutes into it. With that being said, if you learned anything from today's video, I need you to do something that costs you absolutely nothing. I want you to go use the top link in the description down below and just sign up for finchat.io. They give you 2 weeks for free to kind of try the website and do everything. There's only one sponsorship that I've taken on this channel, and there's a very high likelihood that this is going to be the only sponsorship I take on the channel. I personally use the product every single day, and I've been using it from before I was even affiliated with FinChat. I'm seriously not exaggerating when I say this is incredible, incredible software, and quite literally saves me hours and hours of time every single week just researching stocks, going through transcripts. The Copilot feature alone, where you could, it's ChatGPT for finance, and it's like trained on conference call data and that type of stuff. You could ask it literally anything, and it's an excellent summarization tool. Gives you a bunch of charts that are correlated to it, and actually literally points you to the exact slide where some of that data regarding your question was shown, right? So just incredible stuff. Again, top link in the description, costs you absolutely nothing, but if you do want to have the full functionality version of the website in the long term after your trial runs out, they are offering a 25% Black Friday sale for a very limited time, so be sure to check that out if you're interested in that. Thank you very much for watching, and again, I'm looking forward to your feedback in the comments down below. Have a great day.